Yeah, welcome my dear students. I hope you can guess it. We'll start with AS12. Now friends, basically a very small standard in series of group 1 accounting, that is nothing but government grant. Here you have to remember what are types of grant in the second accounting treatment. If you look at types of grant, then grant can be a monetary grant or a non-monetary grant. If it is monetary grant, I can divide it as for purchase of fixed asset. Within that, I can say the fixed asset can be a depreciable fixed asset or a non-depreciable fixed asset. Second, as promoter's contribution. Third, as revenue grant. And for expense loss incurred in previous year. These are the four bifurcation we can have as far as monetary grant is concerned. That I can get a grant for purchasing an asset, fixed asset, which is a depreciable, or I can get a grant for purchasing a non-depreciable fixed asset. As a promoter's contribution, government is promoting my project. So for the whole amount, or I can say whole project, they are giving me an amount. Revenue grant, it means the company is being held, or I can say helped, for day-to-day expenses. And of course, some loss or expense which have been incurred in previous year, for that I am getting grant in the current year. So for loss or expense incurred in previous year, in the last year, you have incurred some loss. For that you are getting the grant. If it is a non-monetary grant, then what is the stuff we have? Nothing but asset at concessional amount, and second is nothing but asset at free of cost. Yeah, so this is what you have to remember. These are the types of grants. So basically accounting treatment you have to remember for depreciable, non-depreciable, promoters, revenue, expense loss incurred in previous year, asset at concessional rate, and asset at free of cost. I will revise off the whole journal entries through our chart which is there in our textbook. Of course, these are some definitions and all those things. Yeah. Now, if it's related to specific asset, related to a specific asset, that is a depreciable asset, then what is the accounting treatment? I have two options. Either I go for capital approach or I go for revenue approach. If I go for capital approach, then I should reduce it from the cost of the asset. If I go for revenue approach, then I will credit it to deferred government grant account. So my dear students, this first part is nothing but capital approach, credit to the fixed asset account, charge depreciation on the reduced value. Yeah, that is the first option available. And otherwise, I go for revenue approach, then credit the government grant to deferred government grant account. Okay, I'll just write down that small word there, deferred government grant account, and show in balance sheet as reserve, and write off this to P&L over the life of the asset in ratio of depreciation. So this B is nothing but revenue approach, and this A is nothing but our capital approach. Now simultaneously, this is for receipt of grant. If this grant gets refunded, then whatever accounting treatment you have done, just reverse it. Just reverse it. Original accounting treatment will be reversed. So if you have reduced it from the cost of the asset, add to the cost of the asset. So debit to fixed asset account, charge depreciation on revised value prospectively. Now debit to government grant, this is nothing but this is B part. That is, if it is revenue approach, then you have credited to DGG account, and then what happens? This DGG is transferred to PNL in the ratio of depreciation. So when refund happens, you have to debit DGG only to the extent of balance, and any excess will be debited to PNL. So this is nothing but with respect to my first part, depreciable fixed asset. Now if it is non-depreciable fixed asset, then I have three options available. First, reduce from the cost of the asset, that is credit to fixed asset, or credit to capital reserve account, but in certain cases defer it and credit to P&L account in the period which such costs are incurred. Means again DGG approach. So this two, I will say it's a capital approach. Either you reduce it from the cost of the asset, or you show it as capital reserve, whereas this is nothing but revenue approach. Just a small change I have to make in the theory here. Even in your textbook you should make it. Of course, if it is refunded, so debit back to fixed asset account, debit to capital reserve account to the end of balance, and debit to P&L account if any balance. Yeah, debit to capital reserve, no, here debit to DGG, deferred government grant. It is not capital reserve, debited to DGG account. Here also there is nothing like extent of balance. Whatever amount is there, debited to capital reserve. Sometimes the refund is more than the amount of grant what I have received, then only the debit to PNL if any in excess. Here it is written is because of that only. Yeah, here please make a change. It should be debit to DGG account to the extent of balance, and any excess should be debited to PNL. Yeah, so this is nothing but our non-depreciable. Three things are there. In the nature of promoter's contribution, though only one approach, credited to capital reserve. And if refund happens, debit to, not deferred grant, my dear, debited to capital reserve. Yeah, it is basically means this part should come here and this part should go up. Just it has been interchanged. Debit to capital reserve account to the extent of balance, and debit to P&L if any excess is there. This is promoter's contribution. Now friends, for expense loss incurred in previous year, that is fifth, and fourth is nothing but my revenue grant. So fourth is revenue grant. Now what is this revenue grant? Grant is intended to compensate for expense incurred in past or to be incurred in future. Means this year I have incurred the expense, so my entry will be credit to P&L. If there is refund, this is refund part, then debit P&L. But if I have received grant for future expenses, then I should credit it to DGG account, deferred grant, and that deferred grant will be amortized or written off to P&L. So credit to deferred credit written off to P&L in the period over which related cost is there, and debit to deferred credit account to the extent of available balance, of course. So within revenue grant you have two parts. If pertains to current year, then credit P&L. It pertains to future year, credit deferred government grant, and that deferred government grant will be transferred to P&L over the period in which the costs are incurred. Fifth is nothing but for expense loss incurred in previous year. Credit to P&L account as extraordinary, and if the refund is there, this is refund part, debit to P&L. Now, grant in kind. Now my friends, if it is grant in kind, I have two options. A, nothing but asset at concessional rate. Asset at concessional rate. Means the asset value say 1 lakh, government is selling me that asset at 45,000. So I should recognize it at 45,000. So asset account debit to bank 45,000. The second part is asset is free of cost. Standard says recognize it at nominal value, token value. This is asset at free of cost. Account at token value, say rupees 1 or 1,000 by debiting asset and crediting P&L. Or more appropriate, it will be capital reserve. Now my dear students, refund is not given anywhere. AS is silent on this. So basically discussing anything about refund will be against the AS, because AS is totally silent. So whatever you say will be based on your wisdom based on normally accounting what we do. But nowhere does the AS say what is to be done if a non-monetary grant is refunded. So I would suggest let it be that it is received. Don't think about refund of a non-monetary grant. Yeah, just we have given that points just for our understanding. So this is all about our AS12, my dear, a very small standard. Yeah, you just have to think in this way that I receive the grant and there is a refund. I receive the grant and there is a refund. This is how you remember all types of grant. So this much as far as theory is concerned, my dear students. Let me go for the question answers. Of course, classwork questions have already been done, taken care of. Let us do some homework section and past paper questions. Santosh Limited received a grant of 8 crores from government for setting up a factory in backward area. Out of this grant, the company distributed 2 crores as dividend. Santosh Limited also received land free of cost from state government but has not recorded it in the books, but as no money has been spent. In light of AS12, examine whether the treatment of both the grant is correct. Obviously not. Santosh has received 8 crore from government for setting up a factory in backward area. Can I say this is nothing but a grant which is in the nature of promoter's contribution should be credited to capital reserve, and no dividend can be given from the balance which is tending to the credit of capital reserve. You cannot give dividend. Yeah, so the accounting treatment done by Santosh is wrong. By giving dividend, even you have received land free of cost, you should recognize the land at fair value. It is to be recognized at fair value, or nominal value, as the case may be, with credit to your capital reserve. So here the first part, it's not available for distribution of dividend, and the second part. So it is incorrect. Nominal value can be 1 rupees, 100 rupees, 1000 rupees, or the fair value of the asset. But remember, if you recognize the asset at nominal value, no depreciation is to be charged on it. Of course, this is solution, a theoretical question. Very small questions, friends. Some of the questions are already done in the class, so I'm not discussing that also. Explain brief the treatment for refund of government grants in line with AS12 when it relates to revenue. So if relates to revenue, I will debit P&L, credit bank. But if we have credited deferred grant account, then what should we do? Then we should debit deferred grant account to the extent of available balance and credit bank. Difference will be debited to P&L. If grant relates to specific fixed asset, sir, I had reduced from the cost of the asset, add it to the cost of the asset. Sir, I have treated as deferred grant, then debit deferred grant to the extent of available balance, balancing figure P&L, and credit to bank. If the grant relates to promoter contribution, then what? So debit capital reserve. So this is what 3 situations, my dear. You just have solutions. You may just have a glance over the language which is to be used while writing these answers. Okay, one more question I'll do, because rest all questions are repetitive. How would you treat the following in the accounts in accordance with AS12 government grants? 35 lakhs received from local authority for providing medical facilities to the government. Can I say, my dear students, this is revenue grant credited to P&L. 100 lakhs received as a subsidy from central government for setting up a unit in notified backward area. Friends, this 100 lakh is received as a subsidy should also be credited to capital reserve account. 10 lakhs received from central government on installation of anti-pollution equipment. This is nothing but grant received for purchase of an asset. So reduce it from the cost of asset or treat as deferred grant. This is May 19 question, friends. See, 35 lakhs received should be credited to profit or loss account. Promoter's contribution, then we should say this should be capital reserve. And the last, capital approach, 10 lakhs installation. 2 methods of presentation are there. Either you treat it as a capital approach or revenue approach. Clear, my dear students? So you may just go through the solution, nothing big, but these are theoretical questions which have been asked, which will give you an idea with respect to what answers are to be written. Yeah. So a very small standard, my friends. Not to worry about this standard. Just you have to remember when you receive the grant, what accounting you do. So on refund, what should be the accounting? This is the crux of this standard. So I'll end up the revision session for accounting standard 12. Thank you very much for watching. Bye bye.